The world drifts through a fragile calm, unaware that beneath its economic foundations, cracks have already begun to form. Nations operate under the belief that progress is permanent and growth is guaranteed, yet every data point tells a different story. In major financial centers, investment banks celebrate record profits while quietly documenting rising risks. Asset prices inflate beyond historical precedents, fueled by speculation, leverage, and unchecked optimism. Governments adopt expansionary policies, assuming that markets will self-correct. Corporations report earnings that mask dangerous levels of debt. Households increase consumption, relying on credit that stretches far beyond sustainable limits. As pressure builds, the first warnings emerge in subtle shifts. A slight decline in manufacturing output, an unexpected rise in unemployment claims, a sudden contraction in global trade flows. Economists dismiss them as momentary fluctuations, yet the signals intensify. Energy prices become volatile, currencies fluctuate unpredictably, and banks tighten lending standards. Investors begin to question valuations in overinflated sectors, leading to small but persistent declines in stock markets. The deterioration is slow and almost invisible to the general public, but in boardrooms and government offices, tension begins to grow. The crisis accelerates when debt-dependent institutions face liquidity shortages. Highly leveraged corporations struggle to refinance loans as credit conditions tighten. Hedge funds unwind positions, triggering a chain reaction across global markets. Bond yields rise sharply, increasing borrowing costs for governments and businesses. Emerging economies experience capital flight, their currencies losing value at alarming rates. Commodities, once stable, become unpredictable, affecting energy, food, and raw material prices. Confidence evaporates rapidly and markets begin to fall in unison. Households feel the shock as consumer prices soar. Grocery bills climb week by week, rents increase, and fuel becomes unaffordable for millions. Families reassess budgets, cutting discretionary spending and postponing major purchases. Small businesses struggle with rising costs and reduced demand. Restaurants close, retail stores downsize, and service industries lay off employees. The slow erosion of economic stability transitions into a sudden collapse as unemployment rises sharply. Banks report surges in missed loan payments and defaults, further restricting credit availability. Government intervention becomes unavoidable. Central banks hold emergency meetings to inject liquidity into collapsing markets. Interest rates are slashed to near zero levels to prevent mass bankruptcies. Stimulus packages aim to stabilize households and businesses, but implementation delays reduce their immediate impact. Political leaders deliver speeches promising recovery, yet public anxiety intensifies. People line up outside banks, fearing withdrawal restrictions. Panic buying becomes common in supermarkets as concerns about shortages increase. Global supply chains fracture under the weight of the crisis. Factories halt production due to lack of raw materials. Shipping costs skyrocket as logistics companies face fuel shortages and declining demand. Ports experience congestion from delayed shipments and reduced manpower. Nations reliant on imports confront empty shelves and escalating prices. Export-driven countries face collapsing demand, leading to layoffs and increased poverty. The interconnected nature of modern trade magnifies the crisis, turning local failures into global catastrophes. Unemployment reaches levels unseen in generations. Skilled and unskilled workers alike lose income, leading to a rise in homelessness, hunger, and social instability. Governments expand welfare programs, but bureaucratic delays create bottlenecks, leaving millions without assistance. Protests erupt in major cities as citizens demand action and accountability. Social tensions escalate, creating divisions along economic, political, and ideological lines. Criminal activity increases as desperation grows. Communities struggle to support vulnerable populations, relying on charities and volunteer organizations to fill gaps. Financial institutions collapse as losses overwhelm reserves. Banks with insufficient capital buffers fail, prompting emergency nationalizations. Insurance companies face claims they cannot pay. Investment funds freeze withdrawals to prevent bank runs. Pension systems buckle under market declines, threatening the retirement security of millions. The financial sector, once viewed as a pillar of stability, becomes the epicenter of the crisis. The collapse spreads internationally, triggering coordinated interventions from global organizations attempting to prevent total systemic failure. The crisis reveals structural weaknesses long ignored by policymakers. Excessive reliance on debt, fragile supply chains, overconcentration of wealth, and inadequate regulatory frameworks. Economists debate root causes, blaming deregulation, global imbalances, speculation, and geopolitical tensions. Some describe the crisis as inevitable, a necessary correction to decades of unsustainable growth. Others argue it could have been prevented through prudent oversight. The debate intensifies as governments search for solutions while attempting to restore confidence. Families adapt to new realities. People take on multiple jobs, engage in informal labor, and rely on community networks for survival. Bartering becomes common in areas where currency loses value. Schools struggle to operate as budgets shrink. Healthcare systems face shortages of medicine, staff, and funding. Mental health deteriorates as millions cope with uncertainty, fear, and hopelessness. Despite widespread hardship, stories of resilience emerge. Communities forming mutual aid groups, neighbors supporting neighbors, and entrepreneurs innovating with limited resources. International relations deteriorate as countries blame each other for the crisis. Trade wars intensify, sanctions increase, and diplomatic cooperation breaks down. Nations prioritize domestic stability over global welfare, weakening multinational institutions. The absence of coordinated global leadership prolongs the downturn. Protectionist policies deepen the crisis by reducing trade, slowing growth, and increasing geopolitical risk. Global fragmentation becomes one of the defining characteristics of the worst economic crisis in history. Global markets attempted to stabilize, but every effort revealed deeper structural fractures that had been building for decades. Investors watched in disbelief as major stock exchanges around the world triggered circuit breakers multiple times a week. Currency volatility intensified as nations tried to defend their weakening economies. The US dollar, euro, yuan, and yen, normally anchors of stability, began shifting unpredictably, pulling emerging markets into a spiral of debt crises. Countries dependent on foreign loans struggled to service interest payments, forcing emergency negotiations and IMF interventions that offered relief on paper but ignited domestic unrest. Corporations faced liquidity shortages that cascaded across industries. Manufacturing hubs saw output collapse as orders evaporated. Factories ran at minimal capacity, and many shut down entirely as supply chain disruptions intensified. Shipping routes experienced delays of weeks, and freight companies increased prices to cover fuel shortages and insurance risks. Warehouses filled with unfinished goods, while retailers struggled with empty shelves. The imbalance between supply and demand widened daily. Businesses that had survived multiple recessions discovered that this crisis operated differently, faster, deeper, and more synchronized across all sectors. Unemployment surged globally, with millions losing jobs in a matter of months. Service sectors, restaurants, travel, hospitality, tourism, collapsed first, followed by heavy industries, construction companies, and technology firms. The world watched as once stable multinationals announced mass layoffs. Entire departments disappeared overnight, and workers with decades of experience found themselves suddenly expendable. Job boards filled with CVs that no employer had the capacity to review. Government unemployment systems crashed under unprecedented demand. Social frustration grew as households burned through savings, feeling the pressure of rising prices and shrinking income. Banks attempted to strengthen reserves but struggled as loan defaults skyrocketed. Mortgage holders missed payments, credit card bills went unpaid, and businesses failed to service debt. Foreclosures surged across continents, leaving neighborhoods dotted with abandoned homes. Housing markets flipped from overpriced to unsold. Real estate investors withdrew, construction projects halted mid-progress, and financial institutions absorbed massive losses. Stress tests designed for moderate downturns failed to predict the sheer magnitude of defaults, exposing vulnerabilities at every level of the banking system. Government debt reached record levels as nations deployed stimulus packages, emergency subsidies, and rescue loans to avoid total collapse. Public spending increased dramatically even as tax revenue declined. Economists warned of debt traps that could take decades to unwind. Countries faced impossible choices: cut public services to save the budget or increase spending to prevent social unrest. Both options carried severe consequences. Political stability eroded as citizens questioned leadership, demanded accountability, and protested rapidly deteriorating living conditions. Inflation accelerated due to supply chain collapse and commodity shortages. Food, fuel, medicine, and essential products saw relentless price increases. For many families, daily life revolved around stretching limited income to cover basic needs. Choice disappeared, survival became the priority. Governments introduced price controls, yet black markets grew as producers refused to sell at regulated rates. Long queues formed outside supermarkets. Panic buying became common whenever rumors of shortages spread through social media. Trust in institutions continued to decline as officials struggled to manage the crisis. Energy markets deteriorated rapidly. Major oil-producing nations faced revenue shortfalls, while import-dependent countries struggled to secure supplies. Renewable energy infrastructure offered partial relief, but not at the scale or stability needed. Rolling blackouts became normal in many cities. Factories adjusted shifts to match unpredictable electricity availability. Households used candles and battery-powered lanterns to cope with nightly power cuts. The fragile balance between supply and demand broke apart, demonstrating the vulnerability of interconnected modern energy systems. Education systems worldwide suffered long-lasting damage. Universities lost funding, student enrollment dropped, and research programs collapsed. Teachers and staff faced layoffs, and schools struggled to maintain operations. Many students abandoned education altogether to support families financially. The global skills pipeline narrowed, intensifying concerns about future workforce shortages. Access to quality education became a privilege, deepening inequality on a global scale. Healthcare systems faced simultaneous pressure from financial constraints and overwhelming demand. Hospitals ran low on essential supplies. Clinics reduced services due to funding shortages. Mental health cases increased dramatically as economic strain pushed individuals beyond psychological limits. Physicians reported rising cases of stress-related illnesses, malnutrition, and chronic conditions, worsened by lack of access to care. Governments pledged support, but struggled to deliver timely solutions due to bureaucratic delays and depleted budgets. International relations grew strained as countries prioritized domestic survival. Export bans, trade restrictions, and territorial disputes intensified. Alliances weakened as nations accused each other of currency manipulation, unfair trade practices, and hoarding critical resources. Global forums called for cooperation, but geopolitical tensions overshadowed discussions. The world fragmented into regional blocs, each trying to secure its own economic interests at the expense of others. Inequality reached unprecedented levels. Wealthy individuals secured assets in stable currencies, overseas properties, and protected investment channels. Middle-class families, once confident in their future, saw decades of progress erased. Lower-income populations faced the harshest consequences: job loss, food insecurity, inadequate healthcare, and rising living costs. Violence and crime increased in urban areas as desperation spread. Governments deployed security forces to maintain order, fueling debates about civil liberties and human rights. The crisis revealed the extent of global over-reliance on debt-driven growth. For decades, economies had expanded not through increased productivity or innovation, but through borrowing. Corporations borrowed to buy back shares. Governments borrowed to fund infrastructure. Consumers borrowed to maintain lifestyles. When the debt cycle finally snapped, it unleashed a chain reaction that no nation could escape. Economists began debating whether the world was witnessing the end of an era, the breakdown of a financial model built on credit expansion, consumerism, and speculative investment. As Part 2 progresses toward deeper instability, nations grapple with the reality that recovery will not be swift or uniform. Old economic frameworks fail to explain the scale of collapse, while traditional policy tools lose effectiveness. Confidence, a fragile pillar underpinning global markets, shatters as people witness the disappearance of jobs, savings, and security. The crisis transitions from financial downturn to humanitarian challenge, forcing the world to confront its vulnerabilities with no guarantees of relief. Banks continue to struggle as defaults rise. Credit markets are frozen in some regions, forcing even solvent institutions to ration loans. Businesses, both large and small, halt operations, delay investments, and implement mass layoffs. Factories operate below capacity, while logistics networks collapse under congestion and cost spikes. Consumers tighten spending, reducing demand for goods and services. In cities, lines form at banks, grocery stores, and fuel stations. Citizens exchange goods informally where possible, while local governments attempt to maintain essential services. Global trade slows dramatically. Shipping containers remain idle at ports, freight costs spike, and trade disputes intensify. Commodity markets swing violently as supply shortages coincide with currency fluctuations. Energy and food markets are particularly volatile, and countries with heavy import reliance experience inflationary pressure. International bodies attempt coordination, but unilateral protectionist measures limit effectiveness. Governments prioritize domestic stability over global collaboration, amplifying tension and uncertainty. Financial institutions scramble to stabilize. Hedge funds liquidate assets, insurers reassess risk, and pension funds adjust portfolios. Central banks inject liquidity and temporarily lower rates. Credit spreads narrow marginally, yet confidence remains fragile. Analysts warn that temporary interventions may delay but not prevent further distress. Derivatives, markets amplify systemic risk, increasing vulnerability to cascading defaults. Every financial move is scrutinized, yet panic-driven behavior continues to dominate investor decisions. Labor markets continue to deteriorate. Temporary gig and part-time workers lose hours, while full-time employees face layoffs and furloughs. Social safety nets strain under unprecedented demand. Unemployment rises rapidly, leaving millions without steady income. Job retraining programs are introduced, yet coverage is limited and demand far exceeds available resources. Communities attempt mutual aid and grassroots support, but scale and coordination remain challenges. Stress and anxiety among affected populations intensify, impacting social cohesion. Housing markets falter. Mortgage delinquencies rise. Evictions increase and property values decline. Renters struggle to pay rising costs, while homeowners face foreclosure. Governments implement temporary moratoriums and support programs, but the sheer scale of affected households overwhelms available measures. Investors become cautious, halting new projects and delaying maintenance, further depressing market confidence. Housing, a critical stabilizer of economies, becomes a focal point of instability. Small and medium-sized enterprises face existential threats. Lack of credit, declining consumer demand, and supply chain disruptions force closures. Local economies weaken as jobs vanish and tax revenue decreases. Entrepreneurs face uncertainty, unable to secure loans or navigate bureaucratic relief. Community-driven initiatives provide some relief, but the economic contraction remains widespread. Inequality intensifies as vulnerable populations absorb the brunt of hardship. Social and political tensions rise. Protests erupt over unemployment, inflation, and government inaction. Media coverage amplifies societal stress, while misinformation spreads on social platforms, triggering panic and unrest. Policymakers confront rising discontent while trying to coordinate relief. Populist movements gain traction, exploiting economic despair. Governments must balance emergency measures with maintaining order, a difficult task given the scale and speed of the crisis. Supply chains remain disrupted. Manufacturing, transportation, and retail sectors operate inefficiently. Essential goods, including food and medical supplies, become scarce in some regions. Governments and international agencies attempt interventions to stabilize logistics, but bottlenecks persist. Businesses pivot where possible, sourcing locally or adopting alternative delivery models, but disruption remains widespread. The global economy experiences a slowdown in production and distribution, further depressing recovery prospects. Technology offers partial mitigation. Remote work, e-commerce, and digital banking allow continuity in certain sectors. Telemedicine and online education help maintain essential services. AI and analytics assist in forecasting demand and managing supply chains. Yet technological adaptation cannot fully offset the systemic economic collapse. Human livelihoods, confidence, and structural vulnerabilities continue to shape the crisis. As Part 3 closes, economic instability deepens across all levels. Societies face unemployment, supply shortages, and rising inequality. Governments and institutions attempt emergency interventions, yet the sheer magnitude of the crisis challenges their capacity. Global coordination remains limited, with localized measures only partially mitigating impact. The next phase will determine whether systemic reforms, resilience measures, and human adaptability can stabilize societies and prevent a further descent into collapse. Governments implement emergency relief programs. Cash transfers, temporary tax relief, and subsidies are distributed to vulnerable populations. Essential services are prioritized, with food, healthcare, and utilities receiving immediate support. Central banks continue liquidity injections while monitoring market responses. Credit flows to critical sectors are stabilized, though challenges remain. Citizens cautiously resume spending, yet uncertainty persists. Financial markets respond tentatively. Stock indices show minor gains, bond yields stabilize slightly, and investor sentiment improves marginally. Large corporations restructure debt and renegotiate contracts. Banks restore some lending, especially to essential services and small businesses. Analysts emphasize that while stabilization efforts are visible, full confidence is not yet restored. Markets remain sensitive to news, policy decisions, and social unrest. Labor markets gradually adjust. Public works programs, emergency employment initiatives, and retraining schemes provide jobs for the unemployed. Temporary and gig workers find opportunities in essential sectors, logistics, and relief operations. Unions negotiate wage protections, hazard pay, and employment security measures. Social safety nets expand to support households affected by prolonged unemployment. Gradually, citizens regain a sense of economic participation, though recovery is uneven across regions and industries. Housing markets begin stabilization. Mortgage forbearance programs allow homeowners to remain in their homes, while eviction moratoriums prevent mass displacement. Rental relief programs support tenants, and property values stabilize in some regions. Investors cautiously resume real estate projects, signaling incremental confidence. Housing contributes to restoring economic activity and public morale. Small and medium-sized enterprises receive targeted support. Emergency loans, credit guarantees, and business advisory services help businesses reopen or maintain operations. Local communities organize campaigns to support local commerce. Supply chains gradually resume operation as production schedules normalize and logistics bottlenecks are addressed. Despite these measures, a significant number of businesses remain vulnerable, highlighting disparities in recovery. Global trade shows tentative improvement. Ports operate more efficiently, freight flows increase, and commodity prices stabilize. International agreements prevent unilateral disruptions. Countries collaborate on supply chain management and resource allocation. Manufacturers adjust production to meet critical demand, while logistics networks improve coordination. Global economic interdependence begins to reassert itself, yet risks remain as confidence and liquidity are still fragile. Social cohesion gradually strengthens. Community networks, nonprofits, and volunteers continue providing aid. Public sentiment shifts from panic to cautious optimism. Mental health services expand to address stress, anxiety, and trauma. Societal adaptation demonstrates resilience as citizens navigate ongoing uncertainty while rebuilding economic and social networks. Grassroots initiatives contribute to both material support and collective morale. Technology accelerates adaptation. Remote work platforms, e-commerce, and digital payment systems maintain economic continuity. AI-driven analytics optimize supply chains, forecasting demand and preventing shortages. Online education ensures continuity in learning. Telemedicine addresses healthcare access. Technological infrastructure allows economic and social systems to function more effectively during recovery, mitigating some systemic vulnerabilities exposed during the crisis. Education and workforce development continue to adapt. Universities, vocational programs, and online platforms provide retraining opportunities aligned with post-crisis economic needs. Scholarship and relief programs enable students to continue studies. Skills development focuses on sectors critical to rebuilding infrastructure, technology, and essential services. Long-term human capital recovery becomes a key component of economic stabilization. Governments implement structural reforms. Financial regulations are strengthened to reduce risk in banking, corporate debt, and derivative markets. Transparency requirements for shadow banking, hedge funds, and private lending are enhanced. Fiscal policies are adjusted to balance debt management with social support. International oversight and coordination aim to prevent future systemic crises. Policies are designed to ensure long-term economic resilience rather than short-term stabilization alone. Healthcare systems continue adjustment. Funding for mental health, preventive care, and emergency response is maintained. Telemedicine and decentralized service delivery improve access to care. Hospitals operate efficiently despite resource constraints. International cooperation ensures availability of essential medical supplies. Recovery in healthcare contributes to public confidence and overall societal stability. Political systems navigate post-crisis challenges. Emergency powers are rolled back while governments implement reforms. Legislatures debate long-term strategies for economic resilience, social welfare, and regulatory oversight. Public trust gradually rebuilds as transparent actions and measurable improvements become visible. International bodies facilitate coordination and policy sharing, fostering stability across borders. Communities document experiences, creating narratives of survival, resilience, and adaptation. Oral histories, multimedia records, and community storytelling preserve lessons learned. Citizens reflect on the human cost of the crisis while contributing to collective knowledge for future preparedness. Cultural and social resilience reinforce economic recovery by maintaining cohesion and trust.